A law was signed on July 4th, 2025. Most W-2 employees have never heard of it. Those who have heard of it haven't done anything about it. And that inaction is costing them money on every single paycheck. I'm not talking about a loophole. I'm not talking about anything that requires a business, a side hustle, or a lawyer. I'm talking about deductions that were created specifically for people who receive a W-2, and about 3 accounts that can legally shelter up to $33,000 of your income from federal tax in 2026 without changing anything about how you work. If you earn a regular paycheck in the United States and you have never once updated your W-4, this video is directly about your money. Here is what we're covering: the specific provisions of the One Big Beautiful Bill Act that affect W-2 workers, why your withholding is almost certainly wrong right now, and the 3 accounts you should open or fund before December 31st. Stay for the checklist at the end. That alone is worth the 10 minutes.
But first, one important note. This video is for educational and informational purposes only. Nothing here constitutes tax, legal, or financial advice. Tax laws are complex, and your individual situation may differ significantly from the examples used in this video. All OBBBA provisions discussed are scheduled to expire after December 31st, 2028, unless extended by Congress. Verify current law before filing. Eligibility for the tips and overtime deductions depends on your specific occupation and income. Consult the IRS published list of qualifying occupations at irs.gov. Always consult a qualified CPA, enrolled agent, or licensed tax professional before making decisions about your withholding, retirement accounts, or tax strategy.
Let's start with the law. The One Big Beautiful Bill Act, Public Law 119-21, was signed on July 4th, 2025. For W-2 employees, it created 2 brand new above-the-line deductions. Above the line is the key phrase. These deductions reduce your taxable income, whether you itemize or take the standard deduction. You do not need a mortgage. You do not need unusual expenses. If you qualify, they simply apply. Deduction 1. Tips. If you work in an occupation that customarily receive tips on or before December 31st, 2028, servers, bartenders, salon workers, personal trainers, and more than 70 other occupations listed in IRS final regulations, you can now deduct up to $25,000 per year in qualified tip income. The tips must be voluntary customer tips. Mandatory service charges do not count. This deduction is available for tax years 2025 through 2028. If your modified adjusted gross income exceeds $150,000 as a single filer, or $300,000 if you're married filing jointly, the deduction begins to phase out. Below those thresholds, it is available in full. Deduction 2. Overtime. If you are an hourly non-exempt worker covered by the Fair Labor Standards Act, you can deduct up to $12,500 in qualifying overtime pay, $25,000 if you file a joint return. The definition of qualifying is precise. It is the premium portion of your overtime, the extra half of time and a half that the FLSA requires your employer to pay. If you earn $20 an hour and work overtime at $30, the qualifying deduction amount is $10 per overtime hour, the premium, not the full $30. The same phase-out applies, above $150,000 in MAGI for single filers or $300,000 for married filing jointly. Both deductions are claimed on the new Schedule 1A when you file taxes, and starting this tax year, your employer is required to report your qualifying tips in Box 12 of your W-2 using code TP, and your qualifying overtime in Box 12 using code TT. If those codes are on your W-2, those are the deductions. 2 other OBBBA changes happen automatically, no extra forms needed. The SALT deduction cap, state and local taxes, increased to $40,400 for 2026, up from the $10,000 limit that had been in place since 2017. And the child tax credit rose to $2,200 per qualifying child under 17. These are baked into the standard filing process. Now, here is the problem most people are missing, and it's costing them on every paycheck, not just at filing time. Knowing about a deduction is not the same as capturing it. If you work in a tipped occupation or you receive FLSA-required overtime, your employer is likely still withholding taxes as if the old rules apply, because no one has told the payroll system otherwise. You will get a refund when you file in April. That sounds fine. It is not fine.
That money was yours all year. It could have been growing, compounding, working for you, instead of sitting with the IRS at zero interest until tax season. The fix is one form, the W-4. The W-4 is the withholding form you filled out on your first day at that job. Most people touch it once and never update it again, even as their tax situation changes dramatically. The IRS provides a free tool, the Tax Withholding Estimator at irs.gov, that walks you through your income, filing status, and deductions, including the new OBBBA provisions, and tells you exactly what numbers to enter on a new W-4. You print it or complete it digitally, hand it to HR, and the adjustment shows up in your very next paycheck. This takes about 10 minutes. There is no downside. If you work in a qualifying occupation and you have not done this yet, do it this week.
Now, let's talk about the levers that work regardless of what you do for a living. The 401k. Every dollar you contribute to a traditional 401k reduces your taxable income by exactly that dollar. The IRS raised the contribution limit to $24,500 for 2026. If you're 50 or older, you can add $8,000 in catch-up contributions. If you are between 60 and 63, a special provision from the Secure 2.0 Act allows an enhanced catch-up of $11,250 instead. Here is the math in plain terms. $80,000 in income. $10,000 contributed to a traditional 401k. The IRS taxes you on $70,000. At the 22% bracket, that is $2,200 you simply did not pay this year. And the money is compounding, tax-deferred, until retirement. If your employer offers a matching contribution, the common structure is 50 cents for every dollar up to 6% of salary, that is an immediate guaranteed return before a single dollar of investment growth. Failing to contribute enough to capture the full match is leaving your own compensation on the table. Not a metaphor, just math. If your health insurance is through a high-deductible health plan, stop here. You qualify for an HSA, a health savings account, and it is the only account in the U.S. tax code with 3 simultaneous tax advantages. Contributions are tax-deductible right now. The money grows tax-free inside the account. Withdrawals for qualified medical expenses are completely tax-free. Pre-tax in, tax-free growth, tax-free out. No other account does all 3. In 2026, you can contribute $4,400 with self-only HDHP coverage or $8,750 with family coverage. The money rolls over every year, no use-it-or-lose-it expiration. After age 65, you can withdraw it for any purpose and simply pay ordinary income tax, making it function as a second retirement account with better tax treatment on medical spending. If you have an HDHP and you are not maxing your HSA, you are leaving a triple tax advantage unused. The last account has the largest long-term cost for doing nothing, the Roth IRA. You fund it with after-tax dollars. It grows completely tax-free. In retirement, withdrawals, including all gains, are tax-free. No required minimum distributions, the cleanest long-term tax shelter available to an individual in the United States. In 2026, you can contribute up to $7,500. If you're 50 or older, add $1,100 for a total of $8,600. There is an income limit. For single filers, the ability to contribute phases out between $153,000 and $168,000 in modified adjusted gross income. For married couples filing jointly, the phase-out runs from $242,000 to $252,000. Below those thresholds, contribute the full amount. Here is the reason this year specifically matters, the 5-year rule. For the tax-free growth to qualify at withdrawal, the Roth IRA must have been open for at least 5 years. That clock starts with your first contribution. An account opened in 2026 starts the clock in 2026. An account opened in 2027 starts it in 2027. You cannot go back and fund a year you missed. Even $1 contributed this year starts the clock. Open the account now. Fund it over the course of the year. The 5-year rule rewards the people who started early and punishes waiting. Here is your 3-step checklist. Step 1, OBBBA eligibility and W-4 update. If you receive tips or FLSA-required overtime, verify your occupation at irs.gov, then use the tax withholding estimator to file an updated W-4 with HR. Your next paycheck should reflect it. Step 2. Maximize pre-tax employer accounts. Confirm your 401k contribution is high enough to capture your full employer match. If you have an HSA-eligible health plan, fund your HSA. Together, these two accounts can shelter up to $33,250 in income from federal tax in 2026. Step 3. Open or fund your Roth IRA. If your MAGI is below the phase-out, make a 2026 contribution before the April 15, 2027 deadline. Earlier means more tax-free compounding time. And if you have never opened one, do it this week to start the 5-year clock. 3 steps. They stack. A W-2 worker in the 22% bracket who maxes both the 401k and HSA can shelter up to $33,250 in income from federal tax in 2026. The Roth IRA compounds that advantage over time, growing and distributing tax-free in retirement. No business entity required, no exotic strategies. The tax code, used the way it was designed to be used.
The tax system is not built to explain itself to you. It's built to collect from people who don't know where to look. Everything we covered today is published by the IRS. It is available to every eligible worker. The only thing standing between you and these benefits is knowing they exist and acting before December 31st. If you want a dedicated breakdown of any one piece, how to actually open and invest in HSA, the backdoor Roth IRA for high earners, or a step-by-step W-4 walkthrough, leave it in the comments, and that's the next video. Thanks for watching.